Next up is our second keynote speaker, and that is Hedley Widdop from Lion Selection Group. Now, the great thing that you need to know about Hedley is not only does he understand the financing of mining projects, working with Lion Selection Group, understands the sort of the money aspect of things, but he's also a geologist by background. So he gets both sides of the coin, if you understand what I'm saying. Anyway, we're going to hear from Hedley, second keynote of the day. I hope you're getting lots of value so far. His title is the Lion Roaring? And Will You Get Bitten? Hedley Widdop, welcome to the Virtual Gold Conference.
Thank you, Kerry. And that was a very kind introduction. Thank you. Sometimes when people introduce me as a geologist, it seems like faint praise, and that seemed like a really nice way of introducing me. So I appreciate that. Look, I took your title and thought through what I needed to talk through. And, in this time, I've been reflecting on the world at large and what's going on. I've got friends all over Australia, been talking to them, trying to just, get some outside contact, to be honest. And I realised, the world really is a different place. I mean, we've got AFL stars walking around Brisbane. 6 weeks ago, they weren't getting recognised. They almost are now. And I suspect that's because the Broncos are having the worst season they've possibly ever had. So the world truly is upside down at the moment, not just in the stock market, it is socially as well. That's not entirely my backdrop, but I think it's worth remembering that anything unusual that we see in the world of mining and the stock market is reflected pretty wholesomely in the world that we live in as well. So I think with your backdrop in mind there and the title that you gave me, I want to talk about the sort of interaction between the three major things which are going on in our world. Well, two major things from our world, three major things if you include my world in that. So we have a global pandemic that has led to an economic disaster which is ongoing. And I think tied to that, there is a gold mining boom, which has only just started. I'm going to be the only presentation today probably that doesn't have a gold price chart. But I can assure you that the gold price is going gangbusters at the moment. Those are tied. It's not necessarily reflected against the whole mining sector, but gold has benefited all on its own, and gold is an enormous part of the mining sector. And for that reason, it washes through. So a lot of mining people are feeling this. In order to get into this properly, though, I thought it's probably worth starting with a bit of a recap of the period which has brought us to this year. So 2011 to 2019 is as far back as we need to go. And I've got the ASX 100 Resources Index here. So this is the biggest mining stocks listed in Australia and what they've done over a circa 8-year period, 11 through to 19. I'm going to add the gold stocks to that, principally because they start and finish at more or less the same position. But also because if you look at the bigger stocks, BHP, Rio, etc., they often experience a slightly different investor sentiment to gold stocks. And what I wanted to show was that these things have actually moved in tandem since about 2016, plus or minus a little bit of volatility. Casting our mind back, in 2011, we experienced the start of the longest correction that we've ever had, I think, in living memory in the mining space. In fact, longest and deepest. It was extremely painful. Mining investment shut down across the industry and investors took their money elsewhere. Come 2016, early 2016, we flipped over from the end of the bust into the start of a new boom. And at that point, almost, we saw investors realize that miners were no longer financially irresponsible or losing money and actually represented good value. And money started to flow back into the sector. That was first felt in the bigger stocks, BHP, Rio, etc. And it gradually worked its way through to some of the smaller producers. So come the end of 2019, and sorry, this is one effect of the new world that we live in, is I just need to shift your head and my head, Kerry, to the other side of my screen so I can see what's on the right-hand side. In the years following 2016, we saw a gradual increase in the signals from the industry that money was flowing back into it. The first thing was, and this was sort of mid-2016, we saw the IPO market open again. For a period of time there, it was very difficult to list a company freshly on ASX or anywhere. And 2016, we saw a willing acceptance by investors of new listings. Not a lot of them, but nevertheless, those listings that took place were embraced. Um, Off the back of that, I would say, I think it was mid-2017, we saw the change in the trend in exploration expenditure, which comes through in Australia, at least from the Bureau of Statistics. We've seen a mirror in this worldwide, although the extent of the recovery in places like Africa probably lagged Australia, for example, on how rapidly money was being spent in exploration. But this is a really good indicator that the industry feels great about itself and where it's getting its money, because it's prepared to spend money on things which don't have certain outcomes. And off the back of all of that, once growth interest really kicked in, we've seen serious M&A start back up again. And 2019, 2018 were pretty big years for that. We've seen two of the biggest gold companies created off the merger of Barrick and Randgold, and then similarly Newmont and Goldcorp, to create two very, very large brand new gold producing companies. They're probably the biggest deals that we've seen, but likewise, we've seen M&A right down through small producers getting together and being re-rated off the back of that. So coming into the end of 2019, we found ourselves in a fairly healthy correction, a fairly healthy stretching its legs type stage of the boom, which started in 2016. And you might notice, I think probably a lot of the audience are already aware, we've got 3 clocks on that image with the hour hand pointing to a different time each time. So this is the lion clock, and I'm indicating how that's changed as we've gone from one side of the page to the other. In 2011, we had midnight, which is when the bust starts. 6 o'clock in 2016, when we tick over into a new boom, and we're now sitting, or I should say in 2019, we were sitting right on the cusp of moving towards 9 o'clock. Now, we just summarised about 8 years in one slide, and to talk about the last 8 months, we probably need almost as much room. So I'm going to just talk about 2020 off the tail end of that. And we've got the same ASX 100 resource index, and I overlay on that gold. And the first thing which I intended you would be struck by is that since the dip in the middle of the page, the gold sector has really taken off. Having traded more or less in tandem with the larger stocks, the gold stocks are now head and shoulders well above those. At the start of the year, much like the end of 2019, we were sitting just shy of 9 o'clock. And in late February, we saw, call it the COVID crash, equity markets globally washed out in response to COVID-19, which had emerged from China and was making its way into every other country in the world. It's interesting to note, having seen a crash which took around about a month, stocks have recovered quite quickly from that. And the underlying condition which led to that crash, COVID-19, hasn't actually gone away. In fact, I mean, in a lot of parts of the world, it's tightened its grip as opposed to having been under control. Some parts, I think, Victoria is a great example, thought it had it under control, and we've since seen a pretty horrible resurgence of that. That's the worst example in Australia. Of course, places like the United States are far worse. The recovery that we've seen, and we'll talk a little bit more about this later, of course, is built off the back of massive stimulus. I think in April, I was wondering whether the market would go lower. When we first saw the signs of recovery in the market, I thought that would be short-lived, personally. We've seen that stick, and I think if there was any sense of ongoing risk in the equity market, that has certainly melted away. So we find ourselves in August. We're a good 4 or 5 months past the crash, and that recovery seems to have got its claws in. COVID-19 hasn't gone away, and in that period of time, we've seen a massive increase in the gold price, which rivals what happened, I think, over 2019 and early 2020 put together. So what I thought I'd contrast then, having had that recap, is then versus now. January, if you like, 2020, compared with August or July or September, probably won't be too much different. So pre-COVID versus post-COVID. This is a pretty obvious rehash of what I think probably everybody realizes the effect of COVID is. In January, I went to Canada. I visited a company which I do a bit of work with there, and we were lamenting where the share price was and what that meant for the funding consequences to work towards building a new project, which is high grade, it's gold, it's a very exciting project, but with a share price in the mid-20s, we were worried about what the funding consequence would be. Gold was healthy, and we could see that our project had an excellent NPV, IRR, all the rest of it. But even so, it was still a difficult proposition at that stage. It was also remarkable, I think, that I went to Canada. I mean, I haven't been anywhere other than the supermarket for all of that time. And here we stand in Victoria. I'm not supposed to go more than 5 kilometres from my house, and it's supposed to take under an hour. So travelling to Canada really does seem like quite a different thing. So borders are closed, travel has been restricted, interactions have been severely cut back, which is something that I think a lot of humans rely on for maintaining positive psychology. There's been an immense economic shock. This is comparable with the Great Depression on many metrics, such as unemployment, and I think some of that is still to wash through. The outlook is certainly not great, but it's helped by the stimulus measures which have been rolled out, which is probably the biggest difference between now and the Great Depression, was that governments have stepped in to try and support markets and economies. It has a very real human effect as well. As of this morning, there I think is more than 770 deaths accredited to COVID-19. So this has had a tragic effect. Even so, with that as the backdrop, global equity markets have recovered strongly. And it's interesting when you hear people like Warren Buffett talk about the way that markets perform and inevitably build to higher and higher value points collectively. He talks about a century of upheaval. If you look at the 1900s, you had a Spanish flu, you had World War I, World War II, a depression. There was all sorts of catastrophes which took place. Nevertheless, over 100 years, global markets added tremendous value. So there's always confidence that when a catastrophe takes place, markets will look through those after a period of time. In this case, markets have looked through it before it's even finished. So we're in a really new paradigm there. And we're faced, I think, with an outlook here which includes global sovereign debt, which is so high, it's sort of beyond shock level now. It's kind of got to the point where we've seen so much blood and guts on TV about this that it no longer scares people. And I think that's probably a worrying thing. But given we're talking about the gold market, it's got a very positive effect. Another before and after, which I thought it was worth showing, this is just each of the sectors on ASX compared then versus now, or with a little bit more detail. So you can see the pink bars, each sector, that's how far it fell in percentage terms in the crash in February, March. The green bar is the recovery. And I think it's interesting here that the biggest recovery we've seen, bar the gold stocks, which is on their extreme left, is the tech stocks. And that has been an extreme example from the States. Australia has a very small tech sector, but in the States, where it's an enormous tech sector, that's really led the market. And the golden bubbles are comparing each sector with its 2020 high, or its pre-crash high, and its 2020 open. So the first thing that I want you to notice from that is that gold equities are up almost 30% in 2020 and are almost 15% above their pre-crash high. So gold equities haven't just recovered from this, they've stretched their legs and gone well beyond it. Much of the market, though, is below its pre-crash high. In fact, a good 2/3 of the market is on a negative performance for the year. And if you looked at the number of companies, I suspect that the number of companies on ASX which are below zero in terms of performance is probably 50-60%. If you weight that on market cap, there is a huge amount of market cap on the right-hand side of this chart. So it's probably well over 2/3. The biggest shock, I would say, in the mining sector in terms of then versus now has been on money which is flowing in. And I won't wait to conclude why this is. With the gold price jumping, there is a hell of a lot of money which has gone chasing gold. So liquidity, which is the amount of money which is available for the sector, particularly for explorers, which is the junior end and is hardest to fund, has jumped massively. In January, if you were talking to investors and you're an exploration company, you might have them listening, but investors just seem to be seeking the very best of the stories that were in the exploration space. There was one or two which were popping, but usually it was rewarding success. There was a strong preference for safe jurisdictions, and I can see that melting away country by country at the moment. And exploration funds could be raised, but fairly selectively. So if you had a really good story, the money would flow at you. But if you were anybody else, not so much the case. We had the COVID crash in February, March, and here we stand. Investors are really warming to explorers. I mean, investors are seeking out explorers now as opposed to just rewarding discoveries, they're actually pricing exploration potential in companies. So we've seen that risk metric flip on its head. And this is definitely applied to gold companies as opposed to many others. But there are a number of stories outside the gold space where explorers are getting real market traction before they've actually delivered a discovery. And it's based on neurology as well. So, this is starting to move outside of just where the price action is in the commodities. Jurisdiction wariness is definitely diminishing. I'm involved in that company in Canada has a project in Mongolia, and having had a share price in the 20s in January, here we sit nudging 60 cents off of the back of Eric Sprott having invested and a new discovery taking place. All of a sudden, Mongolia seems a whole lot less of a risky place as far as people wanting to put money into companies. And if you're looking for gold, it will be funded at the moment. The exploration funds were selected before. I think if you can roll out the golden carpet now, investors are very likely to walk up it. One of the best examples that I've been able to find of this is from the Canadian market. And part of the reason why I've used Canadian example here is that you can't get equivocal data for Australia, which I think is a bit of an embarrassment for ASX, but that's the way it is. This is the amount of money which has been raised across all forms of financing, IPOs, secondary placements, rights issues, you name it, on the TSX and the TSXV. And this is another way which the Canadian market is really useful to look at because it's two-tiered. You have a lot of junior stocks on the TSXV and you have the larger stocks on the TSX. So it's almost got an index breakdown to it, even looking at that level. Going right back to 2008, 2009, 2009, you might remember, was sort of the darkest year after the GFC. And yet we see that being the last major high of money raised on the Canadian exchange. So that was a year when there was a lot of recovery financing going on. The biggest companies were raising money to shore up their balance sheets, and money flowed to them for that reason. Following on from that, years 2010 and 11 were kind of the peak of the mining boom. So that is the point where we really want to be comparing with where we are now, because that was when liquidity was flowing to the juniors in particular. The trend really diminished after that. 2011 through 15 were horrible mining years. And what you can see is that they were locally very low totals of funds raised. But you can also see that the dark blue bars at the bottom, which is the TSXV raisings, the juniors, were of a very low proportion to the rest of the mining market, if you like. Going on from there, the Canadian market has been pretty slow in terms of having this liquidity catch up. In Australia, we've had a pretty reasonable set of years, 2017 through 19, in the exploration sector in particular. But that's because I'd say the Canadian market, which is the biggest mining market for equity in the world, was distracted. So money which might buy risky things like exploration was fascinated with cannabis, which was working off of a legal platform. All of a sudden, medicinal cannabis could be produced, and there was a lot of money flowed into that, feeling it would be a big market. The Canadian market is definitely waking up. When I was in Canada in January, the bankers were all saying cannabis was last year, it's gone. The money is now chasing metals, so show me metals. So the money was starting to flow back, but it is flooding back now in Canada. Taking those overlays off and just looking at the proportion of total funding that is contributed by the TSXV, on the right-hand side, we've actually got numbers now which reflect 2011 sorts of levels. So I see this as a very healthy sign. 2011, if you remember, was actually sort of a recovery boom off the back of a massive boom ending in 2007-8 by the GFC. So we're seeing money coming into junior stocks here like it's 2011. It's not going to be like it was 2006-7 for a little while yet. In 2019, there was one financing on the TSX of about $7.7 billion. It was a Friedland financing, and that looks to have diluted this trend. So I actually see this line going straight across, but it does dip on that number. Looking, so in good years for the junior stocks, we see the TSXV contributing a high proportion of the raisings. And in good years, we also see the mining funding as a proportion of the total funding on TSX and TSXV as a high proportion. So we see that in 2009 at a high level, in 2010 at a high level, and we're back at that level in 2019. And I suspect we'll see that once the 2020 figures are totally in. to look at 2020 just as a snapshot, 2019, this is month by month total money raised on TSXV. So it's the small end of the exchange, and you can see that it just adds each month, going up at a reasonably constant level. When you overlay 2000, or in fact, it's worth mentioning that through 2019, gold went up by about $230 an ounce. So, you know, it had a tailwind, you would say, but it wasn't blowing it out of the park. In 2020, I think it's worth remembering, just looking at this picture, TSXV financings for miners are up 50% year on year, and that's to June. July would have been a massive month. So I think if you were to put July figures on here, you'd be sitting at the top of the capital Y by now. Gold has gone $260 an ounce in January to June. It's gone another $280 an ounce since June. So this has pushed money into the mining market. And it was a slow start this year as well. So to be 50% above reflects a pretty challenging market early in the year as well. Canada's coming back to life. The money is flowing back into explorers in Canada, and that enables the rest of the world's markets and money to sort of stretch their legs. Because whilst the Canadians were doing nothing, it was like a big anchor slowing us down. So on liquidity, again, January versus August, exploration has been hit to an extent that travel restrictions have inhibited activity, although people working in the bush seem to have been able to maintain some level of activity. So whilst COVID does have an effect on the physical activity of exploration, it hasn't slowed down money wanting to find its way into that space. And when there's money in the space, it finds a way of being spent. So seeing some successes in 2019, there was a number of discoveries that year. Seeing the gold price jump, investors are now throwing their money into that. Fundraising is another great way of looking at liquidity. We've just seen that the Canadian market is back. Massive liquidity injection into the explorer space. Wholesale funding of the market, if you like, has jumped massively in that time. In the M&A space, I think it's interesting because whilst we've had a huge increase in the growth appetite of the mining industry, and we've seen M&A start, target valuations, so the companies which could be takeover targets, have become quite expensive. It makes it harder for anyone who wants to buy something if that is constantly increasing in value. And it also makes it harder that if you approach that company, they're going to have a bit of a strut about them. They don't need you as the big takeover group to be providing value for their investors. It's happening. So you need to be prepared to offer a sizable premium. And I just think it's going to be difficult to see big premiums coming in the current market that we're in. And this is a comment very much derived from gold, but I think that behavior is probably going to exist across the rest of the market unless there is some deep value offered by juniors versus producers in whatever space they're in. And commodity prices, the effect of COVID has been a softening in most commodity prices on the weakened economic outlook. We've seen a bounce in them, but if you look at things like copper, nickel, iron ore, they had the COVID dip, but haven't returned to prices which were above the trend that they were in sort of 2018-19. Gold is the difference there. Gold has jumped above that. And all of the presenters who show you their gold charts for the rest of this conference are going to be showing you how that has really jumped this year. And if someone asked me the one reason why that has happened, I would say gold has become mainstream. So in 2019, to buy gold, you more or less had to be a gold investor. To buy gold now, well, I suppose the analogy of, you know, I got in a taxi the other day and the taxi driver was talking about, I haven't been in a taxi for months, and I don't think many people have, but I can assure you, if you were to get in a taxi now, the driver would be talking about gold. Okay, so gold has become mainstream. It is being talked about in the mainstream media. There are a number of articles each day in the paper about gold. Warren Buffett's buying gold. You know, it's an interesting headline. I'm not sure if it was Warren Buffett who sat down one morning and said, let's buy some Barrick, or if it was one of his underlings. But nevertheless, you have big generalist money pouring into this space. Gold is a big market, but it is not enormous. You put that much money in it, it inflates very quickly. I think it's worth talking just quickly about the equity market risk, because this impinges on liquidity into the mining market. So what I'm showing you here is the ASX 100 index. In fact, it might be the All Ordinaries even. There you go. It is the All Ordinaries. So that has recovered 36% since its low post the COVID crash, but it's still 14% off of its highs. You can see where the COVID crash was. I've put the thing that comes out and gets caught in your mask each time you cough. If we just overlay on that, and this is a great example, I think. This is the NASDAQ from the States. So the NASDAQ has recovered 61%, but it's now 12% above its highs. And I think this is where people start to get concerned about how sticky a recovery is, because we still have a backdrop of a very weak economy and weakening, very high unemployment, a lot of people suffering and things like this. Yet markets don't seem to be reflecting that. Clearly that's been propped up by stimulus. Yet here we have a market, particularly in the States and the NASDAQ, which has torn away like the fundamentals have improved out of sight. Now, in the months that followed the COVID crash, lots of people were talking about dead cat bounce, there's going to be another crash. And as much as I shared that view, what tempered a bit was that I can't think of any crash which has ever taken place in recorded history where 50% of the market participants expected it to happen. If they expected a crash to happen, the crash is probably happening rather than because their behaviour will drive the market. So given that there was this expectation of that sort of a recover of a further crash, I think it was actually quite unlikely to stick if there was to be another weakening. We're yet to see if this will happen, but I've got to say that each day that goes by with strength in the market, it feels like we're further from any sort of a further diminishment of equity market weakness. It'll sneak up at some stage. I just don't know when. So to bring this all to a finish, this is the Lion clock as it stands now. And I'm sorry, Kerry, I had one animation to put on this and I failed. I've showed you what time it is before I've actually put my concluding remarks on. So the conclusion before I get to the clock is that liquidity has surged massively post-COVID into the small end of mining. Investors are now valuing potential rather than rewarding success. Clearly that is driven by gold. I'm seeing it spread into other interesting exploration situations. So it's clearly not restricted to gold. But we're measuring this at the front of the wave, not where all the trailing positions are. So in early 2019, we were moving towards 9 o'clock. And I haven't done the ballsy thing of saying, here's where the hand is, but I'm saying that we're moving through 9 right now. So we've definitely moved into the most exciting part of the boom.
2 minutes left, Hedley.
Well, that's it from me. So if there's any questions, Kerry, I'd be very happy to take them.
Hedley, I've got a number of questions. If you can stop sharing your screen, that would be awesome. You mentioned before that a lot of the commodities, including iron ore, are not up to their highs. But what I'm seeing is iron ore is on a tear. It's really expanding massively. But what I'm also hearing in the market is that it seems like it's just a little bit overvalued at the moment. And should investors start, look, I know gold is very strong, but the people listening to us right now are going to be saying to themselves, what do I do? Because there is inherent risk when we have a look at what's going on. Even with the gold prices having a bit of a pullback at the moment, should people be sitting on the sidelines, or do you think stronger for longer?
This cycle as a mining boom is definitely driven by gold at this stage. And there are historic examples which would suggest that a boom can take place purely driven by one commodity. And it's not going to be an iron ore boom or a copper boom or a nickel boom. It's going to be a gold boom or an everything boom. So I can't tell you whether I think that there's going to be a strong recovery of most of those other commodities off of the back of this. Tend to think that when COVID passes, if we haven't had a washout in the global equity market, that's when you will see the economic recovery driving greater consumption and also the prices of those things. I don't think that they could weaken tremendously from here, but at the same time, looking for that upside, I think you need that economic signal, which will be the global economic recovery. Now, in between now and then, there could be an equity market crash. And if that happens, it will take liquidity out of the mining space, the same as everything else. Gold might perform differently through that. It will be weakened for a period of time, I'm sure, but it may perform differently through that to the rest of the equities. But I would probably have one eye on the risk of an equity market crash at some stage, or weakness at some stage, before I start looking in detail at those other commodities.
Hedley Widdop, we've run out of time, but Hedley is going to be joining us in the Zoom room at 5 o'clock this evening. So if you haven't already registered for our Zoom networking, that's your opportunity to get into the chat room and ask Hedley questions about what's going on. Fantastic presentation, Hedley. We really appreciate you joining us on the Virtual Gold Conference today.
It's my pleasure. And I'm looking forward to the Zoom so much, I'm going to change my shirt before we get to it.
We'll see you at 5 o'clock later today. Thanks, Hedley.
Brilliant.